So what's so terrifying about this prediction? Terrifying is a really, really strong word. So it's important you stay to the end where I share my views on what all this means. But let's jump in. Okay, according to the Motley Fool, Warren Buffett just sent Wall Street a historic $127 billion warning. Okay, let's jump into this. Berkshire now has a record $325 billion of cash in short-term investments in their portfolio. And why is this a big deal? Well, Warren Buffett is one of the smartest investors, one of the most successful investors in history. And so when he starts raising cash, you have to ask yourself, why is he doing this? And let's put it in perspective. Let's make sure that it's not, $1 million today is not the same thing that it was 20 years ago. Let's put this into perspective, okay? So Berkshire Hathaway, this is so the first report I shared with you was as of the end of September. So let's go back and let's look. Where was Berkshire Hathaway's cash holdings at the end of June? There was a similar warning in the end of June of 2024. Also from the Motley Fool, thank you Motley Fool for this information. Berkshire Hathaway's $189 billion cash stockpile is larger than ever. Now, so in June, it was almost $190 billion. And then by the end of September, it was $325 billion. It had increased by $127 billion. So this is a big number. So as of the end of June, this is how the cash position as a percentage basis compared. And you can see it's pretty close to the historic average. So why am I concerned? Well, let's look at that record $325 billion that the last report, as I record this video, how is that in perspective? Take a look at this chart. First, I'm going to show it to you before the recent run-up. So you can see it's starting to go up in absolute dollars. But let's take a look at where it is now. You can see that huge rise just recently, right? And to me, I don't know. I haven't talked to Warren Buffett about this. I was fortunate. I was able to meet him once, which was a wonderful experience. But I have not talked to him about this. But, oftentimes I have a saying, don't share with me what somebody has said. Share with me what somebody is doing. I think that's really critical in a lot of aspects of our life, not just investing. And I also think that it's important for all of us to have a long-term strategy. Like I said, stay with me to the end because I'm going to share with you my views on what this means to all of us. So am I right to say that this is shocking? Am I right to say that this is terrifying? In my mind, I think I am. I hope you agree. So that I laid the foundation. So why might Mr. Buffett be doing this? We've all been talking about stock market valuations. And there's two investors that I really respect a great deal. The truth is there's probably 20 investors I respect a great deal. But two of the smartest minds in the financial market are Warren Buffett and then another gentleman by the name of Schiller, Professor Schiller from Yale. And both of them have measures that they like to use to measure the economy, to measure the stock market, that gives us a feel of how are things doing historically. So let's first start off with Schiller's ratio that he likes to look at. And he basically says, how much are people willing to pay for $1 of earnings from a company? So if a company's got a PE of 20, that basically means that investors are willing to pay $20 for a dollar's worth of earnings today. But the problem with that is that bounces around a lot. So what Professor Schiller came up with is he looks at a 10-year period. It's called the CAPE ratio, cyclically adjusted PE ratio. And it's basically just a 10-year look back on the earnings. And it adjusts for that and says, how are we doing from a historical standpoint? And that's what this chart shows us. I want to thank current market valuation for this chart, but it shows us that CAPE ratio, this again is from Shiller. It shows us that CAPE ratio. And this was as of the beginning of 2024. So we're now in 2025, and the stock market was up 20% last year. So it is above this level. So that orange line in the red line, that's 1 standard deviation and 2 standard deviations above. So you can see, we've been here before. It's not uncharted territory, but we're towards the high end. You can see, things got really crazy above 3 standard deviations in the late 1990s, and that would have been a good warning sign for people. Okay, so that's Professor Shiller's. What about Warren Buffett himself? Warren Buffett has said, he doesn't call it the Buffett indicator, but what he says is he likes to look at the total U.S. stock market value divided by the gross domestic product of the country, the goods and services that the country's producing. And this is as of May. You can see the total U.S. stock market valuation was, let's call it $56 trillion, and the annualized GDP was a little over $28 trillion. So that gave us a Buffett indicator of about 2 times. How does that compare historically? You can see here the 1 standard deviation and 2 standard. So we are at 2 standard deviations, probably past that at this point. So that would say that things are historically expensive. Now, it doesn't mean we should sell. I'm not trying to induce panic. What I'm trying to encourage everybody to do is take a long, hard look at your long-term asset allocation. What percent of your portfolio is in stocks? What percent's in bonds? And does that make sense for good times and bad times? It's natural when the market has had, a pretty good run since October of 2022, where the market kind of bottomed out for 2022. We've had a really good period of time. Yes, there's been a pullback recently, but from October of 2022 to October of 2024, over that 2-year period, the market was up 60%, 60%. That's a big, big move. Why do I want you to look at your allocation? What percent's in stocks and bonds? Because it's a lot it's a lot easier if you've gotten in front of your skis. I'm from a ski town. If you've gotten over allocated on stocks, boy, it's a lot easier to trim that down to your long-term allocation in good times before the market has had a big correction. So I'm a firm believer that success for the vast, vast majority of us is about time in the market, not timing the market. So hear me clearly. I'm not saying we should panic. What I'm saying is this is a friendly reminder to all of us to check our long-term asset allocation and make sure we got it right. If you're not sure if you've got it right, I urge you to work with a professional now to make sure you have it right, preferably a fee-only financial advisor. You want to make sure you've got that asset allocation right, because if the market drops 20, 30, 40%, that can be super painful. Do it sooner rather than later while the market's doing well, and also give thought to when you're going to retire. That's why I made this video here. Why waiting to 65 to retire might be a big mistake. I'll see you in that video. Bye-bye.